Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
Well, I've got the insurance guru here in our studio. I'm Anita Finley, and you're going to be hearing RobColson, who is the owner of US Insurance Auditors, LLC. So welcome to the show, Rob, today.
Thank you very much, Anita. Good to be here again.
Yeah, you know, you've been doing a lot of good stuff, and we had a little bit of an advanced discussion about policies and smokers, but maybe we should just get into, you do it, because you told me that there's something very exciting out there. If you're a smoker, you can still get some rebates. Tell them how you do that.
Actually, the industry has changed. Insurance companies are getting a lot smarter to get their market share, so to speak. So what does that mean? That means that in today's market, the insurance companies, as we've spoken about on previous shows, you know, they have their internal mortality tables. So they're well aware of a smoker versus a non-smoker and what those two people's longevity could be at the same age, the same health status, but one's a smoker and one's not. So why do we even bring this up? Well, because a lot of people today are still smoking, and a lot of people still have huge insurance needs, obviously because of their estate size, estate tax reasons, business ownership that they need to off-right. So
that's why they smoke a lot. They're nervous.
That's funny. But
they smoke and they eat.
That's absolutely true. But actually, when they smoke, they don't eat. So
you know, you're right.
It actually curbs their appetite.
Right.
So basically, through the financial planning industry and through working with all the different carriers, there's different programs and planning techniques that are available now today. One of the major carriers out there today, we won't mention their name, but we're working with all of them. So what we are able to resource when doing estate planning and insurance planning for clients and consumers is identify what the reality of their situation going forward could possibly be. Well, what does that mean? Well, we're not in the business of just selling people quick insurance or term over the phone without diagnosing, really understanding what their current needs and their future needs can be. And what does that really mean? Well, if you have an estate and you're trying to offset estate taxes, so when you, or if you're married, you and your spouse pass away, your kids, if you have an excess of $5.45 million as an individual or $10.9 million as a couple, the IRS is going to tax that estate at 40% above and beyond those assets. So you're probably sitting here and thinking, and people on the radio are thinking, well, wow, that's a lot of money. I'll never get to that threshold. Well, the reality of it is that a lot of business owners, a lot of well-established people need this because you've earned all this money over your lifetime. Why would you give it away to the government? Because it's lazy planning. It's bad planning. So let me run through a couple of real scenarios so people have a better understanding of what we're talking about. I have a 47-year-old male, owns his own business, sold a couple of them. I have a 43-year-old female, currently working, both employed. Both intend on currently working through retirement, 65 or around. Already have substantial assets from selling a business. Let's just say, for easy numbers, $8 million. Well, they're not even near the threshold of 10.9. So most people sitting there would say they don't need any estate planning. They're well below the threshold. So the reality of it is what we do is we extrapolate out. We talk to that person and ask them simple questions. How long do you continue work? How long do you wish to continue working? Okay. How long before you sell this business? So, you know, most people today, even when they have assets, they want to continue working. As you know, working keeps us young.
Oh, absolutely.
So they identified that they wanted to work through retirement. So now I have somebody 47, 43, $8 million. So what we're going to do is extrapolate out for them, for their estate attorneys, what that current growth of money would look at 4%, very low, 5%, and 6%. And only growing it for 20 years because they're going to quit working. They're not going to earn more money. So once the bucket's full, 65, 67, he might be, she's a little younger, that money is what they're going to have to retire on. But that money is going to continue growing. So what we do, and this will surprise a lot of people listening to the show, that $8 million at 4% growth, only 4%, over 20 years will turn into $15 million. That $8 million at 5% growth for the next 20 years is going to be $18 million. The industry average, and what the financial planning industry uses, is 6%. Because if you look back at the historical index, which everyone uses, the S&P 500, from 1929 till 2014, do you know what the annualized return of the S&P was?
I gathered that you're going to tell me it's 6%.
It was 10%.
It was 10%.
10%.
So 6 is very safe.
6 is very safe. So for financial planning reasons, we're not going to project 10, because as you know, in 2008, the S&P was down 36%. But historically, it would grow at about 10. So extrapolating that same $8 million now at 6% interest only for 20 years, not their whole life. Now we've got a $23 million estate.
Wow.
So now this gentleman and his wife who have $8 million business, they're young. They have no idea until it's put on paper. And now they're sitting there. Now what do they have? Well, now they have a $12.1 million tax liability or estate liability at 40%. So now, without the proper planning techniques, they have a $4.9 million check to write to the IRS. Their daughter will. They have a daughter, 2 years old. They will be writing almost a $5 million check to the IRS. So now I'm sitting here presenting to these people. They see what the reality of their money growth could be and the tax liability. Now, how do we solve these problems? Well, now the husband is a smoker. He's been smoking since he was in his teens now. He's a 30-year smoker. The wife is perfectly healthy. So when you look at smoker rates today, because of the reality of what smoking does to you physically, the insurance companies aren't stupid. They know this. So they're going to price those cases out 50% more than the exact same 47-year-old male, same weight, same height, same state, same actual profile, but he smokes. So let me give you a real scenario. We're now putting together a $5 million proposal for this estate. The husband's still smoking. He wants to quit smoking. He has a young daughter. So to go into a $2 million policy on a 47-year-old male smoker today is going to cost him for the rest of his life about $34,000 a year.
Because he smokes.
Because he smokes.
And that's not the cost of the cigarettes.
No, that even extrapolates that figure further. So now we're looking to say a $34,000 bill for the rest of his life. However, the non-smoker rate, if he wasn't smoking, was literally cut in half almost. It was in the $20,000 range. So hypothetically sitting there talking to the client, and he said, you know what, I'm 100% going to quit. It's not going to be tomorrow. I guarantee it's going to be by next year. So through the different planning techniques we have, there's a couple of them I'm going to run through for you. I'm going to tell you what we do for the husband and we do for the wife. Normally, we would do a second to die policy on that estate, okay? But if we did that, because of the underwriting difference between a healthy 43-year-old female and a smoking 47-year-old male is astronomical in pricing. So what we did is went out and found a carrier. I won't produce the name on the radio, but this carrier will allow us to write that 47-year-old male as a standard non-smoker. Now, what that program does is give him 3 years to quit smoking. Because at the end of the third year, what he has to do, and this is all he has to do, to save himself almost $14,000 a year for potentially 40 years of life. We're talking a lot of money, $500,000-$600,000 in premiums at least. So we're able to tell the carrier exactly the situation. I have a customer who's smoking. We disclose everything. Everything's underwritten with paramed exams, blood exams, EKG and everything. So we tell the truth up front that we have a client smoking, and it's called the quit smoking incentive. So the carrier will issue this policy as a standard non-smoking case. So now I've taken just for him, I've taken a $34,000 premium for $2 million of insurance, and now I can put him in something for $20,000 for $2 million. Well, remember, I have a $4.8 million problem here, right? For the estate, growing at 6% on the $8 million for 20 years. So now I have the wife perfectly healthy. She's going to come in a lot cheaper. So what are we going to do? We're going to put more insurance on her. She's probably going to live longer. Women normally do, and she's younger. So it's definitely in her favor. We're able to write a $2.5 million policy on her and follow this one. This is a different carrier. I'm not going to disclose the name of that either because that's the art of our game, so to speak. A $2.5 million policy on the wife. Here's the scenario. The numbers I went through at 4%, 5%, and 6%, they're guesstimates, aren't they? Right?
Yep, sure.
Okay. Another guesstimate is inflation that we haven't even talked about. So really what these are guesstimates. So we're looking at now making sure that we don't overinsure an estate. So now how do we solve this problem? We're going to place $2.5 million on the wife. I can do that for approximately $15,000 a year. But here's the trick. What we did for both of them is because I don't want them paying premiums till they're 100 years old or 90 years old or 105 where this policy goes to, we've designed it in what's called a 25-year pay. So the numbers that I'm going to tell you are based on a 25-year pay, and then you stop. So at the age of 72, his policy is paid up for life. So he never puts another dollar in his policy. At the age of 68, her policy is paid up for life. So now let's circle back to the original scenario. The original $2 million policy on a smoker was $33,000 to $35,000 a year for $2 million of coverage. I am now providing, not me, the insurance companies, $4.5 million worth of coverage for the estate, 2.5 times the amount, at the exact same number, less than $35,000 a year. So now I've insured 2 lives for $4.5 million instead of $2 million, and instead of paying premiums until you die, their 25-year pay, and these policies will be paid up for life. Here's the last kicker I'm going to tell you. Again, we're guessing how much the estate could be worth, right? Could be worth $10 million, could be worth $12 million, $15 million, right? So I don't want the clients putting money into an asset they might not need down the road. Now, follow this one. She's paying $15,000 a year for $2.5 million of coverage for 25 years for $2.5 million, right?
Mm-hmm.
The carrier at the 15th year gives her the first option if they don't need it for estate planning reasons because they lost it gambling in Atlantis or they want whatever their needs, whatever happened to this estate.
Yeah.
The insurance company will give her back 50% of all the premiums put in the policy. Now, that sounds good and exciting, but now here's the real important part. Years 20, 21, 22, 23, 24, and 25, right?
Yeah.
For the next 6 years. Now, look at what age they're going to be. She's going to be 63 to 69, retired. Going to know exactly how much they're going to need for estate taxes. Follow this one. What happens if the estate is only worth $15 million? It's a $4 million liability at 40%. It's 1.6. The $2 million policy on the husband will already pay that, right?
Yes.
Okay. So at year 20, they'll give the wife back 100% of all premiums put into the policy. Year 21, 100% of the money back, all the way to year 25. So what's $15,000 a year for 25 years? Say it's $325,000. They'll refund back those premiums to the client 100%. So now they've got all the money back that they put in, $325,000. So now what have we done? We've given the estate $2.5 million of insurance free for the last 25 years.
And he's still smoking. No, he stopped smoking after 3 years. Smoking. But you got it as this is, you see, the reason I like you, and especially to come on the show, is because these are very complicated, and you have specialized in this. You see, I was thinking about it. Many other insurance people would probably say, gee, I'll get all this money. We'll just keep making it up. And, the more money that the policies are, the more money you get as commission. But that's not your attitude. Your attitude is what can you do to make your client have the best, no matter where you have to go to find it. I was thinking this is almost called like blending. You were blending the best of this, the best of that, and now to get her money back, she was doing well without even getting her money back.
Yeah, well, and again, it's This is, I said to the clients, I said, you have between 15 and 25 years to figure out exactly where your state is. Worst case scenario, you get all your money back. Best case scenario, by the time you're both 68 and 72, you'll have $4.5 million worth of insurance that you never have to pay for again. Imagine that.
No.
How many people do you know that have paid up policies in their 60s and 70s?
Right.
None, not very many today.
And that lucky little daughter certainly have enough money. And these people are going to live to be their 90 and 100 anyway.
Well, and it's not the lucky little daughter. It's really speaking to the heart of the client and saying, you've earned all this money, right? They worked all their life to amass $20 million. Obviously, they worked hard for it, right?
Yep.
So why in the world would you have your daughter give away $5 million of your earnings?
Yeah.
On just terrible planning. That's really what it is.
This is great. So who do you actually meet with? When you meet with a client, you go and meet with their attorney. Who else do you meet with so that they understand what a great job you do?
Anyone they want us to. The accountant, the attorney, their brothers, their sisters, their kids. I want them all to be involved. That's really our fiduciary responsibility. And that's what it really comes down to. The old saying is you can lead a horse to water, you can't make him drink. Right. My job is to present the facts. My job is to let everyone know what the reality is and what the correct way to attack that planning concept is. Now, I would really tell you 90% of the people buy in and understand. Their attorneys do. Their accountants definitely know the numbers. And that's how we get the referrals we do. And I'd say 85% of our business is built on continual business because, as you said earlier, you're absolutely correct. These aren't ordinary planning concepts that you're going to walk in a Merrill Lynch, MetLife, Mass Mutual office. As I told my client, I can promise you what would have happened if you walked in any one of those places. You would have already had one policy for $2 million and you'd be paying $35,000 a year.
As a smoker?
As a smoker, sure.
Because they're not going to give you anything that's like as a non-smoker.
No.
And what I loved about it, this is a human side of it, that you are going to get him to stop smoking.
100%.
And so that's what he loved it. His wife loved it. I'm sure it was a wonderful, wonderful thing.
Well, when you look at the savings on stopping smoking, really, for a person who's as young as he is, he's probably going to live 40 years. He'll save $15,000 a year. That's not even time value of money. $600,000 is a lot of money to smoke cigarettes, right?
Absolutely.
But to reiterate one last time is the concept that we drive home is how we individually work and plan each case, because there's no cookie cutter mold for a case like that. I can guarantee you that 95% of the planners out there don't even know what I was just talking about in the concepts and how we use the non-smoking, the refunding of premiums over certain time periods. And it's truthfully based on people's age, their needs, and what their estates need. And I can't tell anyone on a phone call quickly how I can diagnose what they really need. It takes weeks of planning, to be honest with you.
So now that's the time for me to tell you how you're going to get in touch with RobColson. I think you can see that he is absolutely a unique person in this business. And it's a free evaluation, so you can sit with him. He isn't going to charge you. He's here in Boca Raton at his office. The phone number, get your pencils out. Remember, this is Pencil Talk Radio. It's 800-218-5033. 800-218-5033. And the company is US Insurance Auditors.com. And that's a very important name because he really isn't just an insurance salesperson who writes things. I mean, not only does he own the company, but he really cares. He's been around for a long time. And so go on his website, which is usinsuranceauditors.com, and just see what we're talking about. He specializes in the unique. I think that's really a good way to describe you, because so many people could not have put what you said together. There's no way. And so I'm sure even CPAs they bring, it's like their mouths are open. Well, actually, you take a lot of time to do this too, Rob. This isn't casual. You have to go through a lot of independent insurance companies. You have to really have have knowledge of what's right.
I was on the phone with the client on Monday, and it was going through the concepts and how I was going to try and plan the case. Of course, he's doing the trust work, and he was just never heard of it.
Away.
And he does this for people all day long. And he said, to be honest with you, I've never even heard about this. So when my client left the office, I talked to him, of course, and I said, so what did your attorney think? And he goes, I tell you what, he said he thinks that smoker thing is the greatest thing he's ever heard. Really?
Right.
And I said, great. And that's exactly why I want to do business with you and that attorney, because that's our best resource is people who understand what we deliver to the client. And what we can always guarantee them is they're going to get the most thought out, well-placed business they can do. Because we literally have access to every A-rated carrier on the street. So they all have different bells and whistles, and a lot of clients need different things. Your needs might be you're more interested in the long-term care faculty off some of these policies. You know, the next person might be more interested in building income streams should they be younger. You know, any people under 55 are looking for tax-free income planning. That's really what we try and do, and we do all this type of business. So I just encourage people to reach out, call us, and we'll help them out.
So when you first started in the insurance business, were you always like this? Were you always, you just wanted something different, didn't you?
Well, I do, because it's specializing. Everyone can sell a term policy. Anyone can sell you a little insurance thing. The planning thing is the specialization of our business. And, you know, and that's why I encourage people is to know who you're buying stuff from, because it's really an art. And believe me when I tell you, from those examples, the average customer wouldn't even know what I'm talking about, because they probably bought a smoking policy already, and they know what they got for rates versus the rest of the average standard group. So
yeah, it's amazing to sit here and listen to you. You really understand this, and I'm so glad you'll be on YouTube. So if you do miss this, or you missed it, or you can hear it again, because, you know, a lot of times you hear it, but you don't, it's a lot of complications, so you need to hear it again, and then you can also have your CPA or your lawyer or your son or daughter, so on, listen to it also. Hopefully you're not smoking. And so even if you're not smoking, Rob will certainly find you wonderful, wonderful policies like that. Let's go into somebody who has a disease. We don't cover that very much. When you go to get someone covered, what are the diseases that will hold them back or that makes it more expensive?
It's the big ones that become prohibitive a lot of the times are the obvious ones: prior cancer, strokes, heart attacks. Okay, those are hard cases to place. The ones that people probably aren't aware that are placeable today are people with diabetes on insulin pumps. Those cases are very writable today.
But and why is that? Because it's such good technology that it's going to keep them living a long time.
The world of medicine today, you know, they know if people are maintaining their medications properly, and they can tell from looking at people's files whether they've been taking it for X amount of time. And I'm not saying every diabetic on insulin pump is going to get an insurance policy. That's up to the underwriters. But are they getting placed? Definitely. And it depends how long and what type of cancer. I don't want to say anyone who's had a little melanoma because they play golf all their life, they're never getting insurance, because that's very, very far from the truth. What an insurance company is really looking for is 3 or 4 years of no treatment, and that means no medication. So, you know, a lot of people think, oh, I'm perfectly fine. I haven't had a melanoma in 12. Are you still on medication for that melanoma? That's what the insurance companies want to know. So, again, each case is different. Now, you know, we haven't even talked about that. You talked about people unhealthy. They think about the same thing with height and weights. You know, it's easier to get somebody who has diabetes a policy than somebody who's 5'2", 350 pounds. Because they're, you know, the insurance company's job is to look at each person's status, whether it's height, weight, diabetes, high blood pressure, whatever the malady may be, and they price that accordingly. So just like that, smoker's going to get a 50% higher rate just because they already know through their whole book of business and their mortality tables how long that 47-year-old smoker will generally live. So if a normal male is going to live 35 years, they'll put 28, 29 years on a good day on that smoker.
So when people come in and you're evaluating them, it's not just that you're evaluating their financial potential, but also their status, health status, and anything else, because you know what the insurance companies look for. What else do they look for? They look for, you said, so if someone is overweight.
The insurance companies look at everything from your driving record.
Wait a minute. We never never talked about that.
No, that's one of the major things they pull is the DMV report. So right on an insurance application, they'll ask you if you had speeding tickets. If a DUI is a big bad one, they don't like that at all. And they ask you if you had any speeding tickets or anything in the last 5 years, and they're going to pull a DMV report anyhow. So if you're going around town and you have speeding tickets every other week, you're going to have a rated up policy as well. Because they don't expect you to live as long as the other person following the law and doing 55.
Huh. Mm-hmm. Okay, we have that. What else? This is interesting. We've never talked about these things before.
Yeah. So they pull your DMV. They do a full paramed, an EKG, blood profile, chest x-ray if necessary. A lot of things. They can request anything. They might request on a large case for you to go have a stress test, a nuclear test. I mean, they put out guidelines, and whatever they ask, if you want that insurance, you'll have to follow through and do what they ask. But they can ask for anything. If they see something on a doctor's notes from last year, like a follow-up that you might it wasn't cancerous, but you had something removed, they're going to want to follow up on that before they place that business. So you know how most people are. They're like, oh, yeah, I had this. I played, a lot of golf. I had this thing removed 4 years. I'm perfectly fine. Well, you think you're perfectly fine, but did your doctor write that in your notes that you're perfectly fine?
Oh, and so you give them permission to, of course, to get into everything.
Yeah. When we pull all the medical records. The insurance companies pull all your records, and they do a what's called an RX check. So quickly, they have a system that they can see every prescription that you've been written in the last 10 years. So that's how they quickly look at your profile. Like in the health insurance business, that's common. First thing they're going to pull. They go to script check, it's called. And then they can see that, Robert Colson took this, that, and he just said he was on aspirin. So
it's absolutely
they can't pull the wool
amazing.
over their eyes, because the one thing is you can never get away from is a public record, right?
And that's true.
So that's certainly what they look at.
That's why a lot of people who've been told to go because of their health and stress to go to psychiatrists, I'm not going because it's on their permanent record, right?
Absolutely.
Well, Rob, as usual, you're just so brilliant. I just sit here mesmerized. Phone number to call, 800-218-5033. Rob Colson. Go to his website, usinsuranceauditors.com. It's just great, Rob. Thank you so much.
Thank you.